Well, Brian, I think first, as you said, this is a good year, which really shocks people. I find that certainly on the West Coast, people are angry at this bull market, mostly because somebody keeps taking credit for it. But beyond that, you're looking at a low right at, remember, Christmas Eve last year was a real big drop in the market. So I look long term, like you know. So for me, 2019 was a great year, but it averages out as part of this long-term bull market. I don't think we have a recession near term as much as people think. I think next year we'll have 2% GDP, so we should have a reasonable equity market. Maybe not double digit. We're overextended, but at least a positive returning type year.
I think the average return over 100 years is something like what, 7 or 8% annualized, maybe throwing a little bit more for dividends. That sounds about what you expect, Chris.
It is, exactly. We actually start from the 1860s and come forward. And when you look at that time period, you're going to average around 7 with that dividend income being a good chunk of it now. So,
yeah, that's why your money tends to, I think it's what, every 8 or 9 years, you double your money in the equity market at historical returns. Well, it's good to hear that. It's good to hear even some return because, to your point, I don't know about being angry, but there are people that are worried. They say, the market has come too far too fast. Everybody's piled into too few stocks at the very top. So you don't see much risk of a major or even just a minor equity market decline next year.
Well, Brian, I see risk everywhere, that's for sure. But you're right. I think we're due for a good 5% correction anytime in here. The market, the PE ratio isn't at extreme levels. Earnings are at least still coming in strong, although sometimes they're disappointing. But look at the last quarter, you had at least over half of the were positive reports. So I think you're going to still see some compaction for companies and challenges, but generally positive earnings, which yields a positive market. It will be choppy. This is going to be another election year. Remember 2016? That was a really hard year where the market really slugged it out to try and generate a positive return. We may have that kind of year because of all the rhetoric we're going to hear.
It's been a weird year in a way that we haven't had very many pullbacks at all. Do you think, Chris, that's because last December we had this major market swoon of 15%, the worst December since 1931? Did we sort of take all the healthy correction and put it into a very unhealthy 3-week period?
Well, we sure might have. I have to say that correction surprised me. Christmas Eve, frankly, shocked me. I still think the machines were involved there,
of course,
without question, and the lack of traders around. So I am surprised, actually, at last year that we had very few, at least weeks of lower returns with all the global trade problems that we've had and the difficulties we've faced. But it's back to that base corporate earnings. That's what matters. If corporate earnings are doing okay, the U.S. consumer is somewhat optimistic. And look at the jobs reports during the year. Just constantly good news on jobs, and I think that helped fuel this market.
What's really weird, and maybe a risk point that we're not talking about enough, is that CEO confidence is well below consumer confidence. And there's a story up on CNBC.com this week, we've had over 150 major CEO departures this year, some of the most in years, if not ever. So on one hand, CEOs are nervous. Many of them are leaving or being fired, and yet the consumer chugs along. Does that disparity, does that CEO transition and turnover, does that worry you at all?
Well, I think that transition and turnover is just a function of the baby boom. CEO tenure is shorter and shorter, oftentimes inside of 10 years. And there's the fact of people aging. I think we're going to see that kind of turnover until we hit into more and more Gen X, China generation CEOs. But the disparity between their optimism absolutely concerns me. And I think that's a lot of the CEOs are global in nature. They see the difficulty in Europe on one side, the challenges still out of Japan, this whole trade. The fact that trade, finally we might get NAFTA resolved, but all of the trade agreements being put in negotiation at once, that just causes turmoil for the CEOs and uncertainty, and that's what makes them nervous.
Yeah, I know, and trade is such a big topic here, but I actually want to ask about something else. It's a little bit wonky, and I know you're in New York. Is there anybody that you're talking to, or maybe in your own mind, a little more worried about this issue in the repo market in New York City than maybe is being made of?
I've seen it before. As you know, I've been in the business a long time. I've seen that year-end compression. And interestingly, it happened many, many years ago where we had that strange compression in September that caused repo rates to blow out. But the answer is yes. I am talking to people about it. We run over $3 billion in short-term cash. So we're worried about it at CalSTRS. Our trade desk is one of the groups I meet with regularly to talk to about the fluidity of that equity of the liquidity market. I think John Williams and the New York Fed are going to get a handle on this. There are fewer banks in the market providing that liquidity, which is a concern, but the world is awash. And so I think that this year end, we might have a few blips, but the Fed's going to come in and provide liquidity, keep that repo rate in line. That really is almost like the blood pressure. As long as that's within a very good range and healthy, the cash system, and that's what I think, it is wonky, but a consumer needs to know that if the repo rate is fluctuating wildly, it means that the basic cash level in the system is having challenges. And we had a couple of days.
That's why I mentioned it. I mean, it is WBI, wonky but important because it's kind of the bloodstream in some ways, the most basic level. So it doesn't sound like you or people you're talking to believe that this could be endemic or sort of systemic of a bigger issue or the spark that could, set off a bigger sell-off.
I think that September was kind of a gotcha. It surprised everybody because you had three different events come within a week of each other. A lot of people have been planning for this year end and buying cash alternatives that take them over year end or provide them liquidity at year end. So I think people are going to manage this cash period well, and it will be fine. I do not believe it will lead to a problem in the equity market.
And without getting political, because that's not what we're doing, but there could be an impact on equities. What is your best estimation of how politics and the presidential election may impact the markets overall?
Well, when I look back at 2016, there were things going on in the economy that led it to be very slow and very low. But I often wonder how much of that rhetoric just bothered people and made them nervous. And it adds such a level of uncertainty. We have such extreme points of view now coming out, particularly with Bernie Sanders and Elizabeth Warren, that are almost socialist sounding, and then extreme capitalism. And I think that gets investors concerned. Long-term investors may hold off. Companies may hold off capital improvements. That usually is going to put a damper on GDP. So I think it's going to be a problem next year that will cause volatility in the equity market from time to time. But again, it's noise. All that matters is what happens in November, and that just sets the tone in terms of regulation going forward.
Yeah, and hard to believe we've still got 11 months to go. Feels like it's been going on for already a couple of years now. Chris Ailman,
I agree.
Of CalSTRS, thank you very much for joining us here on CNBC Worldwide Exchange. Really appreciate it, and you have a great holiday.
You too, Brian. Thank you.